Alright, Greg Crouse here. Numerous people have requested that I make a video on mistakes new traders make. Well, here we go. In this video, we're going to examine 3 things traders neglect that will likely cause them to fail. Aimed at new traders, but truthfully, most non-professionals failed to do these within the first 2 years of trading. Most professionals were actually required to actually do some of these either by their firm or SEC guidelines. So that's why I say non-professionals. All right, so let's get started. The number one thing that separates a professional from a wannabe trader is keeping a trade journal. Number 2, preserving your capital. That's your money. That's going to be number 2 on the list. And lastly, they don't find a comfortable trading style of trading or grow to dislike it. I know these things are not a strategy or some secret sauce to make millions. Good, because first off, that would make this BS. Because there is not some magic indicator or price action tea leaves that anyone can use to make money. It is what they do and learn from these strategies that will allow them to stack some gains. Now, these 3 things are what make trading a professional activity instead of gambling. I don't care if you've been trading for 1 day or 30 years. If you don't do the first 2, you're an amateur, plain and simple. And if you're not having a little fun, then you'll never keep up with the game. Now, you don't have to like trading per se, but you can surround yourself with people that make it enjoyable. So let's break down each of these items so everyone has at least an understanding of what I mean. Many people fail to actually write down their trades. They do this for many reasons. The number one reason I get by students is the broker app or whatever keeps track of that, or they have some built-in audit software that tracks all that performance. Well, I do care about performance because I like money, but that's all it tells me. Thus, I can't learn from it whatsoever. Every trade should be thought out beforehand. And if it was part of a strategy, there's little you actually have to think about there, right? But after the trade, you should go back and analyze that trade. These are simple questions that you should answer. Why you entered, what was the plan in detail, what actually happened, and then were there any issues that popped up, right? For example, was there a Trump tweet or a Biden stutter that moved the market? Then capture any other info that might be useful. And finally, the most important part. If I could trade this occurrence again, I would do this instead. If this sounds familiar to any military individuals, you've guessed it, it's an AAR, an after action review. Yes, we do them in the civilian world also. Now, this is very simple, and you can make your own notebook in your favorite word processor. I will say, though, I like most people starting off to do this to physically write it down on a piece of paper or notebook. They just seem to grasp the concept much easier this way. Now, on to the second reason people fail. Preserving capital. This one could be a complete rabbit hole if I get going, because this reason is much more than just managing risk, and when I do the list for reasons why intermediate to professionals fail, it will be on that list as well, just covering different aspects of preserving capital. Now, new traders and old traders alike just don't think about losses or potential losses. They think about winnings or how much can they put in their pocket. This will always lead to failure. It's like just playing offense, but not having any defense. Preserving capital sounds easy enough by limiting your risk on each trade to a certain level. And this is what I want new traders to focus on. Limiting their risk, how much they can lose, mainly because it will allow you to learn without going broke multiple times. We always hear that story of the first 5,000 I put in, I've lost it all, and then I put another 5,000 in, I lost it, right? You don't have to lose all these thousands of dollars to learn to trade, right? Now, how often do I hear individuals tell people only risk a certain percentage of your holdings each trade? For example, let's say only risk 5% of your holdings on each trade. Well, that is a simple answer, but completely wrong. If you have 20 trades active and all of them have met that 5% rule and the market dumps and you didn't account for systematic risk, that's overall market risk, then you failed, right? Because 20 times 5 is 100%. So if you put all that money out there and that was your expected loss, you just lost all your money. So simply put, you should limit the overall risk, not just the risk of a single trade. You have to understand your portfolio risk. Now, your risk tolerance, okay, per trade is something different when you're starting out. Now, you can go with that 5% and then just don't enter more than, say, 4 trades at a time, so you know you're only risking a maximum, if worst case scenario, 20%. But there's another thing that people are always going to ask you. What is your risk tolerance? Normally, when a financial manager or an investment advisor looks at this, they're going to say, hey, how old are you? How old are you? When do you want to retire? They're going to get all that information, and they're going to come up with the old school method of finding your risk tolerance, okay? Now, I'm going to tell you, as a new trader, you're not going to follow what they're going to set, because they're going to say, hey, put 20% in bonds, this and that, and it's just out of this world. You're not going to do that. Allow your financial managers and other people to do that. You're here to trade. You want to manage your own money, not all this other stuff. So how do I find what my risk tolerance is? It's simple. Sleep, stress. If you're losing sleep or checking the trade nonstop, stressing out about it, then the risk is too much. Dial it back until it's not a problem. If you cannot put down the phone or stop checking the PC or whatever you're on, your risk tolerance is just too high. Dial it back till you don't have to worry about it. That is where you should be learning. Well, that is where you should be trading even after you learn how to do it all. But also, this is where you should be when you're learning. You don't want to be stressed out when you're learning something new, because there's a lot of stuff as you grow you're going to have to learn much. I will cover much more about this and how much you should be risking on each trade from a mathematical side in a later video. But for now, understand that if you're not entering a trade thinking about how much you're willing to lose and are only focusing on the potential winnings, you're a sucker at the table, and I'm going to find you and take your money sooner or later. Your money is your inventory. Protect it. It is easier to lose and much harder to gain back, especially if you learn what drawdown or drawback is, right? If you lose 20% of your portfolio, now you have to make 25% on what's remaining to get back to just where you were at. So the name of the game is try not to limit your losses as much as possible, and don't just go for the moonshot wins. You have to have a steady plan to continue to make sustainable gains over and over and over. Here at Options Players, we call that stacking your gains, okay? So keep it up, protect that capital, and stack those gains. Lastly, this is one that I've just noticed over time of trading and being in groups and seeing people slowly fail. And this is the one that gets traders slowly. Finding the way you prefer to trade, whether that is day trading, playing overnight holds, options, forex, bonds, etc., etc. That is only the first step, and is often it's okay to change and trade a little bit of options here and then forex here. You're learning, keeping it fresh. That's fine, right? It's totally normal, and you don't really have to think about it any more than that. But first, you do need to enjoy the market. Learning new things, meeting people that also like trading, and so on. You have to surround yourself with people that like to trade. Even if it is a chat room online, a club, it has to be something. This is why Options Players was started nearly almost a decade ago, to bring together like-minded people without all the to the moon BS and everything else. Plus, we like to meet up and have a good time, right? Simply put, if you don't enjoy it, you simply will not put the time and effort into trading that is required. Now, some of y'all are a little older. I'm not a spring chicken, and you don't remember school. But the one thing you'd probably remember is the subjects that you enjoyed or liked, you focused on them. You tried on them. The ones that you didn't, you just did enough to get by. But getting by is not a winning strategy in the market. Now, when starting out trading, Knowing a few strategies, that's great, and I hope everyone can find some winning strategies. But simply put, investing requires you to continue to educate yourself, not just on charts, but understanding of economics, corporate finance, to a level you should have a master's degree with all of that knowledge. If you trade with me for a year in one of my groups, I can promise you, you can earn your MBA with little effort. Hell, I'll even tutor you on my free time and help you get your MBA. I know it will come that easy to you. Simply find people you like trading with and passing ideas off of each other and trade. In the end game, trading is just a bunch of math and educated guesses. So you're going to need people to make it not so boring and also share the highs and lows with. But let's not make this crazy. Find stuff that you like to trade, that you're passionate about. Find people that you like to talk to or be around and trade with them. And try to trade similar stuff. It's that simple. If you find yourself not being interested or falling out of the group, have an intervention. Tell your friends that you're just not feeling like trading anymore and you need a little pump me up. I'm pretty sure you'll find out that it's more of a fraternity/sorority out there than it is some professional club. And we like to have fun. You know, we like to blow those winnings on some fun trips and things like that. So stay involved and educate yourself on trading. Now, I know someone was expecting something, at least one thing different from the three I said. And there are many reasons why people failed. And just being stupid is on the top of that list. All right, I keep it real. But I cannot help stupid, can I? So if you have a reason you failed before or have seen others commit that caused them to fail, then share it with us in the comments. The more knowledge, the better. And learning from others' mistakes is always good, right? But in trading, it can save you money also. Well, I will leave you with this. I don't care if you're new to trading or have you been on the trading floor for decades, though no way you've been a professional, because the first two reasons are mandatory at every firm and the SEC guidelines for some people. So if you do not do these three things, then you should just buy an EFT and call it quits, or hire someone to invest your money for you, because you do not have what it takes and you will be a statistic sooner or later. As bad as it sounds, we need people that are statistics also, so we can grow and stack our gains on their losses. So which one are you going to be?